Hello, everyone, and welcome back to another episode of Making Sense of Investing with Court, where we break down things in the economy and the market so it makes clear, concise, and practical sense. Given that it is Thanksgiving week, I want to first start with a heartfelt thank you to all of my clients for all the wonderful, amazing introductions to your friends and family this year, for your continued trust and confidence in not only me, but also the team standing behind me. And I want to also just use this as a time to thank everybody for opening up. Money can be a very emotional thing, and I find that sometimes I'm not just talking about finances and dollars and cents. I'm talking about real life and big decisions and emotional things. And I appreciate the openness and the transparency and the relationships that I have with each and every one of you. And I also want to take a moment and say how grateful I am for my co-host and director of investments, Noah Brooks.
Well, thank you.
You are welcome.
Thank you so
Noah,
much.
your team does such a phenomenal job for our clients and for all the other advisors at Good Life. But I am especially just grateful to have you here in the office and always lending your knowledge
Well,
to
it
me.
is nice working in the same physical location, right?
I know. You don't get to do that with a lot of the advisors that you work with.
Yeah.
So it's pretty incredible. You've gotten to know a lot of my clients, and I know they really always enjoy hearing from you as well.
And we have a Christmas party coming up.
We do.
Am I invited?
You are invited.
Oh, my goodness. Thank you so much.
Can't wait. Looking forward to it.
Yeah, absolutely.
Noah, what do you have
boy.
on the agenda for Thanksgiving week? I know it's been like a crazy last few weeks with life and
Yeah, well,
whatnot,
I'll tell you
but-
what, the thing that has gotten me is that the government is reopened.
yes.
So now I'm not flying anywhere this year, but if I'm not mistaken, you're flying
We're
somewhere.
flying Black Friday down to Florida for a few
flying
days.
on
So
Black
I know.
Friday. That
I've never
doesn't-
done this. This is my first time doing it. So we'll see what I'm getting myself into. But
So I
could use a little
think,
sunshine in my
I
life.
think we are one of 82 million people that are
Wow.
expected to travel, which is an all-time record for the Thanksgiving holiday. Essentially, I think it's Tuesday through Monday is
Okay.
considered that Thanksgiving travel holiday. So 82 million people. We're going up to Long Island, like a 5-hour drive from here. You're going down to South Florida.
South Florida, yes.
Yeah.
Yeah.
And I mentioned the government shutdown. It's over. I think there was a real impetus for them to move forward through this because obviously how many people travel for Thanksgiving.
Yeah.
And we were starting to see flight delays and shutdowns and
Cancellations.
all sorts of cancellations. I mean, one or 2 days there was over 1,000 cancellations. And I think the elected officials were like, listen, if we don't get this taken care of, it's going to be on us if people miss their holiday plans.
Yeah. I mean, it's a big deal. Thanksgiving travel is always a popular time. And I feel like every year it sets a new record. So having the government open and flights back in full swing is a very good thing for the holidays.
Yeah, but you know what we miss?
What?
Or we're going to miss.
What are we going to miss?
Well, we're going to miss some jobs reports.
I know we are. We're not going to get the October data. So that's a big question mark, right?
We got September after they
Yes.
reopened, which is already yesterday's news. I think it was
news.
118,000 new jobs created in the United States. They've told us, as a matter of fact, that we're not going to get October data. November data, I think, is going to be just fine.
Yep.
I would just, on this note, on the jobs note, I think it's worth noting that we need about 70,000 jobs to be created every month just to keep up with people that are leaving the workforce. There's approximately 70,000 on average that are leaving the workforce every year. So we need 70,000 just to maintain the number of people that are employed, which is about 159 million here in the United States.
Okay. That's definitely an interesting data point, given that we are in the business of helping people retire. So we are part of helping people, go out and live the good life.
A lot of your clients are part of that 70,000 people a month that are exiting the workforce.
They are. And we do need to replace them. And those are important statistics to keep in mind.
Well, so herein lies the rub on the replacement, right? Is that you have major corporations and businesses that are looking to, some people are going to be replaced, but they're determining whether or not they need to replace everybody that's leaving the workforce, right? Due to artificial intelligence.
Yes.
And the productivity gains that is being made by artificial intelligence. And so without going down on a long diatribe on this, it's possible that at some point in the future, we could have less overall workers in the economy and it not be a problem.
Mm-hmm.
Today, if we thought about it, or yesterday we think about it, if you go from 160 million people to 150 million people, that's an economic wipeout. There's a problem.
Mm-hmm.
But it is possible that in the future, we see less people employed and it's not an issue.
Mm-hmm.
So I'll leave it there with that. That was just a little bit of.
It's definitely something to keep back in the mind. And we've been talking about AI now for the last couple of years that we've been doing this show, and I think it is timely that we're bringing that up because AI has really made a lot of news over the last few weeks. If you pay attention, even to I think the general news, it's been on whether or not we're in an AI bubble. So Noah, in simple terms, can you break down what the fear over the AI trade was, where we're at now that NVIDIA, which I think has kind of become a household name for a lot of people, has reported earnings, and just educate our viewers a little bit on that.
Yeah, I think there's two items out there, and they're completely different, whether they're real, imagined, or maybe a little bit of both.
Mm-hmm.
I think those two items are, one, what I was alluding to, that artificial intelligence and the idea of robots are going to take everybody's job,
Mm-hmm.
right? So that's issue number one. And then in terms of the actual bubble, a lot of your clients, and certainly a lot of advisors out there, remember the dot-com bubble.
Mm-hmm.
Right. And so, you're starting to hear things like, well, it sounds similar to that. And so those are the two items that everybody's a little bit concerned about. And let me touch base on the bubble thing first, because the taking our jobs is much more of a future conversation. And I mean, like a futurist conversation. And we could talk about that for hours.
Optimus robot.
Yeah, the Optimus robot. We'll talk about that here in a second. But in terms of the bubble, when you look at the price chart for the NASDAQ over the last 50 years or so, since 1978, there's a nice blue line, and it averages about 10.5% on a trend line for the last 50 years or so. And in 2000, late 90s into 2000, you see prices go way above this trend line. Mm-hmm. And then you see them go way below the trend line, right? And there's a clear bubble there. Mm-hmm. And where we are today is just a little bit higher than this long-term trend line. So from a price perspective, we're not in a bubble. Mm-hmm. From a spending perspective and from an earnings perspective, the S&P 500 is expected to grow about 14%, or earnings from the S&P 500 are expected to grow about 14%. And you're like, well, at first that's wonderful, right? That's great. It's hunky dory, all that good stuff. When you look into the numbers, what you find is that about half of that growth is from the Mag 7, mm-hmm. right? Those 7 big tech artificial intelligence companies out there.
We've been talking about that in client reviews now the last few years.
And so you can
whether or not you own, just to educate everybody, you don't have to own those individual names because they've grown to be such a huge part of the market that they are moving the market. We all own those names, whether individually or as part of a broader portfolio.
Absolutely.
Anybody that has money in the market most likely has exposure to those names.
One of the things that has been helping those companies is this massive spend, mm-hmm. on, well, obviously research and development, R&D, mm-hmm. but then there's this CapEx spend that we've all been talking about, which essentially is building out server farms. Mm-hmm. And in those server farms, there's a lot of things that go into it, but one of the most critical components in that server farm is one of those NVIDIA chips. Mm-hmm. Right now, currently, it's the Blackwell chip from NVIDIA. And last Wednesday or Thursday, they came out and they blew earnings out of the water. It was wonderful, and the stock price went down the next day. Mm-hmm. And so you get a sense that there might be a little bit of a shift an overall perspective, kind of a what have you done for me lately scenario, where just blowing out earnings this quarter isn't going to get us to new all-time highs in the overall market or even in the individual stock, because there's a little bit of a perception that spend that we're talking about, mm-hmm. can't continue, mm-hmm. Indefinitely. I mean, nothing can continue indefinitely, but the rate of spend and the rate of earnings growth that has helped them move forward so much over the last, mm-hmm. 5-7 years, it could, the perception is that could slow down.
Mm-hmm. And the market is always forward looking, which is what we always talk about. So, people will ask that, why is this sector up and this one's down? Or why, is this stock down when it blew out earnings? Because it's always about what's happening in the future. And so the market has to adjust for that.
Absolutely.
And there's a lot of names in that AI space that, it's not just the NVIDIAs of the world. There's a lot of other components. There's a lot of other parts of the supply chain that are involved. So, and a lot of the NASDAQ, which is the technology sector, is driven by those AI names. So the NASDAQ has seen a pretty significant sell-off compared to the rest of the market, but the rest of the market is taking a hit for it because of the size of these companies and the earnings that it has contributed to the overall return of the S&P 500, especially out of the last few years.
Well, let me just elaborate. When you say taking a hit, okay, I know everybody hates to see the market go down, but from a healthy long-term market, you're going to have stocks that go down. You're going to have the market go down.
Yeah.
So since the high, which was just about 2 weeks ago, the NASDAQ is down 6% from the high.
Yeah.
The S&P 500 is down, was down at one point, just a hair over 5%. Today, it's down about 3.5% from all-time highs. This is completely normal.
Yeah. But individual names, some of them are down significantly more. Like you're seeing some things move 7 to 8% in a day. There's been certain instances.
And some of those high flyers, the Reddits of the world, some of the the Palantirs of the world that have been some of the best performers, they could be down 20 or 30%.
Yeah.
Yeah, there's no question about it. But just to go back to some of the pullbacks, what we look at long-term pullbacks, we've seen approximately 8 pullbacks over the last 10 years of 10% or more, right? So we measure that as, you hit a new high, and then how far do you fall from that high? We've had at least 8 of them. The most recent one was just, I say a few months ago, but earlier this year, Liberation Day, tariffs announced, the market fell over 20%. From close to close, it was 19%, right? From top to bottom. We had another 6 instances where the market was down more than 5%, less than 10%. But overall, these are healthy. And this is what's happened in a bull market.
Yeah.
We've had these. So I would just, I would caution people about getting too hyper over the overall market coming down a little bit. Now, there's a few things that have been really beat up, as you said. You mentioned Palantir. For the crypto bros out there, Bitcoin is getting its butt beat in.
It is right now.
Right? It was 120,000 now. I think this morning it was 85,000. You can do the math on it. That doesn't feel good if you own it at 120,000.
Yeah, there's definitely sectors that are, we can point to that have maybe been overbought, and now there's a little bit of coming back down to reality that's going on, and it is healthy. We do talk about that. Having the market always go straight up and not resetting itself is not a healthy place. So it kind of is nice to see that the market is like taking a breather, maybe a little bit of sector rotation going on. I don't know if you guys see that at all, where people are maybe getting out of so much technology and shifting into other sectors of the market?
Well, yeah, there's no question about it. Healthcare, which has been a dog over the last year or two, is starting to find a bid, and people are moving. Like there's a rotation, as you said. I don't want to say out of technology, because I don't think you're ever going to see a rotation where everybody just says, okay, buy tech and like buy tech, not buy. But you're always going to own some technology because of it's a larger portion of the overall S&P 500 and the market itself. But healthcare is starting to see some traction, and you obviously have utilities, which is a function of this artificial intelligence build out. You have this need for more power, right? And there's this demand for more power. We just found out that 3 Mile Island, which is obviously local here in Pennsylvania, they're going to reopen this old reactor they're saying in 2027, if I'm not mistaken.
Oh, wow.
Yeah. And there's a contract with Microsoft to supply electricity directly from TMI to their new server farms.
Wow.
Crazy.
It is crazy. It's crazy times.
Yeah.
Yeah. I mean, I think those names are always going to carry us into the growth phase, but we've seen so much of the growth coming really from that one sector of the market. It would be nice to have more of we've been talking about it as a broadening of other sectors starting to make their contributions to
There's no
overall
question
growth.
about it.
So,
when you look at the other, not so much sectors, but other areas of the world geographically, this year is one of the first years where you have Europe and Asia and the Far East is actually outperforming domestic U.S. companies by leaps and bounds, almost double this year.
Yeah, we've seen that in the individual fund, performance reviews when we do them, how well international has done.
Yeah. So some of that has to do with Russia and Ukraine. And you might scratch your head and say, well, how would that be beneficial? Well, one of the things that's happening in Europe specifically is, so there's this confluence. We have this administration who is kind of pumping the brakes on NATO spending, right? And then you have Europe, which is saying, hey, because the United States is pumping the brakes and we have this war that's raging kind of in our backyard here, we're really going to have to step up and pay for our own defense spending. And so they have a initiative for 2030 where they just passed a budget earlier this year that adds an additional $1.5 trillion in defense spending. And if I'm not mistaken, 70% of that has to be spent on native European companies.
Okay.
So that's one of the reasons that Europe is starting to really get some traction. And then across the rest of the world, you talk about a rotation, if you are leaving large companies and large growth and AI, where are you going to go? Well, maybe you're going to go to Brazil.
Yeah, emerging markets.
Maybe you're going to go to Japan. Maybe you're going to go to China. I mean, they all have their own unique risks.
Yeah.
But this year, they're significantly outperforming in the U.S. markets.
Yeah, that's an interesting data point. As we're talking about, earnings, I think the majority of companies have now reported for the third quarter. So can you give everybody a sense of how did earnings go in terms of expectations, and what does this mean for going forward, right? Because we're always talking about what's happening next, and earnings happen in quarter three, but how does that set us up for the rest of the year?
I'm going to start with this. Here's the stat of the day. Google, when they announced a week and a half ago, they had their first $100 billion quarter of revenue. They generated $100 billion in one quarter.
Yeah.
So these companies are doing just fine. There is no profit shortage among the Mag 7, the top 10. It doesn't matter where you look. Everybody's profitable. So overall, you mentioned most companies have already reported. I think as of today, 95% of all the companies in the S&P 500 have reported. 82% of those companies reported positive earnings surprise, which is pretty big, and 76 reported positive revenue surprise.
Okay.
So this is not a situation where companies are starting to underreport and give poor guidance going forward, although there's always a specific example of that happening. One of those was Home Depot.
Yes, Home Depot.
Their comps were down year over year, and they kind of pumped the brakes a little bit on guidance. But then you have Walmart saying that things are starting to pick up. You have TJ Maxx saying their comps are growing 6-7%. And so you kind of go back and forth and you think to yourself, well, okay, that's great. But are their comps and Walmart's comps going up because people are downshifting? Are they going from Macy's to Walmart? That's probably too big a shift.
No, I mean, there is a statistic that was out, especially with Walmart, that they are attracting kind of the higher end, more luxury shopper. And is that a sense
I
of
don't
the
know
overall?
if that's ever been said in the history of the world.
I know,
before,
but
right?
it's going on. Like, they're talking about it. They're attracting those higher end customers, and it could be a sense of, are we pulling back? Is the spender tightening their wallet? And it's not that they're going there for everyday things. And some of it's the technology innovation that Walmart has done in terms of their online shopping experience too.
Yeah.
So they're attracting like the whole market at this point.
I think one of the things that impacted me personally in 2025, I don't know if this has happened to you, but you go into the grocery store and you do your normal shopping and you just look at something and you think, oh, you know what? That seems to be more expensive than I recollect 6 months ago or 2 years ago. And in my mind, pre-COVID, right? There's this pre-COVID situation and there's this post-COVID situation. And you start doing the math and you think, I wonder if I can get this product at a better price for the same product or similar quality product somewhere else. and you have people kind of moving around to other secondary and tertiary grocery stores or stores in general, I'm going to tell you, we had over the last 3 or 4 months, we've had our first experience with a grocery store called Aldi. Um, and it was okay. I don't know that it was great.
Yeah.
I don't know that it was great, but it was okay. And then what's the other one? Lidl. So Aldi was so-so. Lidl, European company, was phenomenal. And we found some great deals on bargains and things, no name brands, like aluminum foil, but the same exact quality that what we're getting. And so I think you're going to see the consumer, right? They're going to vote with their feet. They're going to say, if I'm feeling pressured over at this store, there's going to be somewhere else that I can go to get that. And that always presents opportunities in the markets.
It does. And going, not to always go back to AI, but going back to AI, with all the built-in search engine tools that are available, there's a lot of these things as you're doing holiday shopping where you can put in the product and it will do the price comparison for you. And it's going to drive you to the same product, lowest cost, price point. So I do think there's going to be some of that going on.
Do you want to talk tariffs?
You can, if you want to, let viewers know how, or if that has really affected earnings at all as of yet, because we did talk about beginning of the year, obviously tariffs were the name of the game. We haven't touched too much on inflation this time around, but there's policy uncertainty. There's a lot that was going on, but this does mark the fourth straight quarter, I believe it is, of double-digit earnings growth for the S&P 500. So that's a positive.
Yeah,
despite
it's really
all
good.
of the other things that we've had to deal with.
What we've heard on tariffs from companies themselves and CFOs and CEOs is that it really just creates more uncertainty. It hasn't been damaging, but it creates uncertainty about supply chains and what they're going to want to do for next year or certainly the year after that. We now have a situation where the legality of tariffs have been challenged, and it is going to rest with the Supreme Court. And they are hearing oral arguments actually as we speak. And what we're going to find out is, so it seems like there's a pretty good chance based on the Supreme Court. There's 5 justices out there that have kind of signaled that they're in the camp that the tariffs may be ruled illegally. So the administration is adding tariffs based on the International Emergency Economic Powers Act. Say that 5 times fast. But it doesn't mention tariffs in there. And so the whole idea for this lawsuit is that the administration is taking the power away from so that the executive branch is taking power away from the elected officials, right? The Senate and Congress. And that's probably going to determine whether these tariffs are legal or not. It doesn't seem like they're going to be ruled that they're going to be legal. Now, I don't know, but it's going to happen. And so the question is, what happens then? Does everybody forget tariffs and we go back to the way it was before? Is the administration going to find a new route to raise revenue? But when it comes to, you mentioned inflation. So we were told really that the tariffs weren't going to impact prices. Well, they may not impact upfront prices that you and I pay, but they impact the cost to the manufacturers and the importers and the distributors. And eventually that has to get passed down. Otherwise, they're going to eat it. They're going to have lower earnings, right? Lower profit. And so we're starting to see that. We also see the big thing that people are talking about today: coffee prices, sugar prices, and beef prices. Well, we added a 50% tariff to Brazil, where we get a lot of coffee, a lot of sugar, some oranges as well, and a lot of beef. And so you're starting to see that in the grocery store, that these prices have come up a little bit, not dramatically, but it kind of depends on
an impact.
It's making an impact. And now the administration is saying, oh, well, we're going to lower some of these tariffs. So I think there's a back and forth happening. I think we need to find maybe a neutral balance of what the right tariff is. I heard, this is no joke, they're talking about 100% tariff on Italian pasta. That Italian pasta is going to be removed from our grocery store shelves because they won't be able to bear the 100% tariff. So I don't know what exactly is going to happen,
Mhm.
but I can tell you that the inflation that we're seeing is starting to creep back up, not in a gigantic way, but we're now at 2.8% after being at 2 point, I think it was 3 earlier
Yeah.
this year. And the Federal Reserve obviously is looking at a 2% number
Mhm.
as their long-term target. We're creeping farther away from that
Mhm.
as we go every month.
So where do you think that leaves the Fed? Because they have some decisions they need to make
Man,
come December.
I would hate to be Jay Powell at the moment.
Yeah.
He's between a rock and a hard place.
Yep.
So first and foremost, Jay Powell next year is done,
Mhm.
right? The chances of him being remaining,
Not happening.
yeah, the chances of him being the chairman of the Federal Reserve in late of 2026 are zero.
Mhm.
Right. So we don't know who the next Fed chair is going to be, but it's not going to be him.
Mhm.
And so the next Fed chair, whether it's Miran, whether it's somebody else that we haven't talked about, or we don't know, they're probably going to be appointed by the administration with a specific task to lower interest rates.
Mhm.
Um, the Fed chair can't do that themselves, right? They need the other governors in there. There's a vote in there. They
Mhm.
can't just unilaterally say, oh, we're going to lower interest rates. They can have their vote and their opinion, but they can't make it happen. And so the Fed is what they call data dependent. They're
Mhm.
looking at the inflation numbers. They're looking at the job numbers. Oh, wait,
We didn't get any
we
in
didn't get any
October.
October job numbers, right? So they're between a rock and a hard place.
Mhm.
I would tell you, I think when you think about the next, let's say, 1,000 points on the Dow or the
Mhm.
S&P, or the next percentage of unemployment,
Mhm.
do you think the next percentage of unemployment is going up or going down? We're at 4.4% unemployment.
I mean, I think maybe up.
Yeah. So you and I can sit here and
Mhm.
figure out that unemployment rate is going up. Do you think the Federal Reserve can do that? They have to know that.
They have to know that. So we're thinking there should be an insurance cut, right?
I mean, 25 basis points isn't going to make or break anything. It seems to me obvious that they should be doing some
Yeah.
lowering. We don't need 50, we don't need 100,
No.
but hey,
Making moves in the right direction to give people
making
confidence that rates are
absolutely,
going to start to come down.
absolutely, and that'll help businesses feel a little bit more
Mhm.
secure for refinancing.
Yep.
Right. So we had this period of really, really low interest rates pre-COVID,
Mhm.
in 2016, 17 into 18 before they started raising. And then we went essentially to zero ZERP, right? Zero
Mhm.
interest rate policy. And it was like that for a few years. And then we had 500 basis points of increases where we went from essentially zero to 5.25%. And so the cost of borrowing went up dramatically. And that by itself isn't bad, but it's the rate of that increase was
Yes.
really fast.
It was really fast, and I think it put a little bit of a freeze on housing market to a certain extent. I mean, people were obviously out there in competitive situations buying and probably overpaying. Um, but there's a lot. I know I personally have a lot of clients that are stuck in this space where they have these incredibly low mortgages, but they've outgrown their home, and then they're looking at, well, where am I going to go that I can afford it? So
Yeah,
it would be nice to see rates come down for the affordability piece of this for, a monthly mortgage payment.
sure.
So we'll see, I guess, what
Yeah.
happens. So December, we're still up for debate whether that's going to happen.
I mean, it seems to me fairly obvious that they should
Yeah.
lower at least by a quarter.
Yep.
Whether they do or not, I mean, I don't know exactly what data. We're not going to get the jobs report, but I don't know exactly what data we're going to see before then, because they've already announced that the recent jobs report that would be out December 4th or 5th, that
Mm-hmm.
Friday the 5th, is going to be coming out, I think, the 18th, which is 2 days after the Fed meeting. So they're
It's up for debate.
I don't think they're flying blind, but they don't have the
Yeah.
information that
And they could
normally
use that
comes
as a
out.
reason to not cut rates.
But like I said, I mean, it's easy to make a case that the next percentage point up or down is going to be up on unemployment.
Mhm.
You don't need to look at the crystal ball to figure that out.
Yeah. Have the indicators there. So before we wrap up, are there any other things or data points that your team is keeping an eye on as you prepare and start to think about any potential portfolio changes going into the start of 2026?
Yeah, great question. I mean, we are cautiously optimistic about the overall market, but we made some changes earlier in 2025. We took a little bit of growth off the table. We added more to international. So
that worked out.
Yeah, taking money out of domestic companies, United States companies, adding international. We're going to probably do that a little bit, maybe 2 or 3 percentage points again in early January. Yeah. Overall, healthcare is starting to rally a little bit.
Okay.
And so we might add a little bit to healthcare. We already have some exposure, but we might add a little bit of that. Other than that, not too many other massive changes in fixed income land.
Yeah, I was going to touch on bonds if there was anything. A lot of clients have fixed income as part of their portfolio.
Absolutely. We have had a wonderful year in fixed income.
It's been nice. We haven't had this in a very long time. It's been a great blessing this year.
The 60-40 is back, I'll say, at least for 2025. Technically, the bond ag, which is the index that everybody follows, is still in a drawdown, meaning we have not hit where we were prior to them raising rates in 2023. So I think we're in something like 2022. I think we're in a 61-month drawdown. That feels like we're ready to break above that. But yeah, I mean, fixed income has done really, really well this year. I am a little bit concerned about the high yield market. So we have moderate exposure to high yield. They used to be called junk bonds. Now we call them high yield bonds. And their spreads, meaning the difference between what government bonds pay and what high yield bonds pay, have condensed dramatically, and the spread is tightened. So you're not getting paid near as much as you used to be
to take on that risk.
And so we would like to add to high yield if there's a spread blowout. Meaning if high yield gets really beat up in 1 quarter or 2 quarters, we might add a little bit more to that. And so that's on our radar at the moment. But I think there's risk out there in the high yield market at the moment. At these levels.
All good pieces of information. I know I have a lot of clients that had CDs coming due or money markets that were paying 4 to 5%, and we even own some of those CDs, and that's just not necessarily the case anymore, especially as interest rates are coming down slowly, but they are coming down. So, keeping in mind, if you have cash that you want to add to the portfolio, a lot of the recommendations that we make are to dollar cost average in over a few month period of time and bring the money into the account, and then our team will slowly, invest it to try to capitalize on our market buying opportunities that we see fit. So again, long-term, you want to be in the market. You want to have exposure to both the equity and the fixed income markets for long-term growth. It's just making sure the funds that you're putting into the market, you don't need in the next day or the next year. In the event that we have volatility, which we always have market volatility.
Matching the time horizon with the right bucket, right?
100%. That will never change. And it's important too, as we wrap up the year, our themes have always been to stay invested and to stay focused and allow our team to do the heavy lifting and reallocating of the portfolios. And Noah and his team have done a phenomenal job of that this year. This was not an easy year to navigate by any means, especially from where we started to the tariff tantrum to where we're at right now. So it's been a lot of noise this year, a lot of headline noise. And the important thing is to always stay invested and remember that the team, behind you is making all the adjustments and changes that we need to. So thank you to you and your excellent team.
Thank you for entrusting us.
Of course. And before we wrap up, the 2026 contributions for retirement accounts, I should say, has been updated and been released. So that will be going out in this month's mailing to everybody.
What's the number for 401ks? It's over 30,000 for
it is
for
over
old guys
for
like me.
Yeah, well, over age 50. I think it's 24,500. I want to say if you're under age 50 like me. Still under age 40 for another month and a half too, by the way. And the IRA contribution limits did go up to, I believe it's $7,500.
And don't forget the super catch up.
Yes, there is the super catch up. I have from 60 to 63, I believe.
So I don't get the super catch up. Why they stop at 63?
I don't know either, because there's a lot of people that are still going to 65 until they can retire, so they don't have
Well,
health
you don't
insurance.
get Social Security until a minimum of 65 in like 5 months. So why would they stop the super catch up at 63?
I don't know.
I'm going to write a strongly worded
I
letter to
think you should.
somebody.
I think you should. So we're gonna include all of that in our commentary. But as we always say, investing can feel overwhelming. Retirement can feel overwhelming. But our goal is to try to simplify everything so that you can make all the big decisions with confidence. And if you need anything from us before the end of the year, don't hesitate to reach out. Noah, thank you again for joining me today, and thanks to all of you for tuning in. We will see you next time. Have a wonderful Thanksgiving with your family.